Materiality and pervasiveness, two important concepts in auditing. Hello everyone, I'm Owais Mirchawala, tutor for advanced audit and assurance. And in today's short video, we'll be discussing these two concepts. One is materiality and other one is pervasiveness. When we talk about the audit activity, concept of materiality is very important. Auditor takes an impact of a misstatement on his opinion if it is material to financial statement. Now, what do you mean by material to financial statement? It means that it is significant enough to affect the decision of the users who are the shareholders. So, if there is a misstatement which is material enough to affect the decision of the shareholders, auditor considers those misstatements as material to financial statement and he takes their impact on his audit opinion. Now, how an issue becomes material to financial statement? So, as per auditing standard, an issue can be quantitatively material, which means material due to its amount, and it can be qualitatively material, which means material due to its nature. Now, auditing standard says that the threshold, the benchmark for quantitative materiality is 5 to 10% of profit before tax, 0.5 to 1% of revenue, and 1% to 2% of assets. Now, what these ranges show us? Basically, the auditing standards say that it is the auditor's judgment that he can select the materiality level from these ranges. If the auditor considers the client as high risk, he may choose the materiality level of 5%. Or maybe he can choose 6% or 8% or 9% or 10% of PBT depending on his risk assessment of the client. So basically these ranges are giving auditor a judgment area to determine the materiality benchmark based on his judgment. Once the auditor determines the materiality level, he considers the misstatements as material to financial statement if they exceed the quantitative benchmark which he has selected. Now, in materiality, another concept is qualitative materiality, that a transaction is material to FS due to its nature. For example, if it is a related party transaction, or if it is an issue in earnings per share, or if it is an issue in going concern assumption, so it will be material to FS irrespective of its amount, because the nature of the transaction is material to FS. So, as per the auditing standard, a transaction can be material due to its amount, which is quantitative materiality, or due to its nature, which is qualitative materiality. And if a misstatement becomes material to FS, auditor takes an impact of it on his audit opinion. It may lead to a qualified audit opinion. Now, one concept is this materiality, which leads to qualification in audit opinion. Now, qualified audit opinion is one when auditor says that financial statement is true and fair except for these misstatements, which means that auditor will use the word except for. He's saying that overall financial statements are true and fair except for these misstatements. Now, there is one concept which we call as pervasiveness. If a misstatement becomes material and pervasive, at that time the auditor says that financial statement as a whole are not true and fair. Now, here the auditor will not use the word except for. He is saying that financial statement do not present true and fair view, which means that he is questioning the entire FS as a whole. Now, the question is that what is pervasiveness? How a transaction becomes pervasive to financial statement? See, the word pervasive means a thing which has a spreading impact, which can affect the financial statement as a whole, and it is sufficient enough to make the financial statement as a whole meaningless. Now, the auditing standard says that it completely depends on the auditor's judgment to determine pervasiveness. Like, for example, if a wrong going concern assumption is taken, it's a pervasive issue, it's a spreading impact. If a wrong revenue recognition policy is used, it is pervasive, it is a spreading impact. It depends on auditor judgment that at what level he thinks that an issue is pervasive, and he should use the word that financial statements do not present true and fair view, which means that he's saying that the misstatement exists in financial statement as a whole. Now, those students who give the exams of audit and assurance or advanced audit and assurance, they must have noted that sometimes the examiner considers an issue as pervasive at 30%. Sometimes he considers it as pervasive at 60%. Sometimes he considers it pervasive at 80%. So why is it so? The reason is that auditing standards have not given any benchmark for pervasiveness. The pervasiveness has nothing to do with these materiality threshold. It is the auditor's judgment to determine a level at which he thinks that financial statement as a whole is creating a misleading impact. Okay? Now, obviously, materiality and pervasiveness also have link with auditors' inability to obtain sufficient and appropriate audit evidences. But I have presented this concept in relation to misstatements. I hope that you people have understood these concepts. Do subscribe my YouTube channel, because I'll be posting series of videos relating to auditing issues. I want you all to give your opinion in the comment box. It motivates us to make further videos. Thank you, everyone.